in just a few things that I'd like you guys to consider. First, if you could please mute all your phones. What we've had happen in prior webinars is that folks have shouted out a question, or they tell us what they're having for lunch because they're talking to their partner next to them. Thankfully, it's not lunchtime, so you won't do that, but we've had some at lunchtime. And we are actually recording this, so if you could mute your phones, it won't be picked up on the recording device, the reel-to-reel tape. Remember that, Marcus? Remember reel-to-reel tape? So that's the first thing. Second, if you have a specific question, please type it into the chat bar. All questions will be addressed at the end of the presentation. So no matter how many exclamation points you put after your question, we are still going to ignore it to the end of the actual presentation. So today, oh, that was a better picture. Thank you very much for putting that together, Bianca. So you have Marcus White, who is a tax partner, our tax partner, who oversees the not-for-profit area.
I'm trying to like back it into the
let's not mute it. Hold on, we're going to mute you. We now have the power to mute people. That's like an executive power that we have. Perfect. Thank you very much for muting. Good. And also myself, Todd Polinack, I'm the partner over the not-for-profit practice, and we are today's presenters. One of the things I told Marcus a few minutes ago is that throughout the presentation, I'm going to ask him to guess who some very famous people are who spoke about the tax code. And if he doesn't guess, he promises that he's going to donate $50 to a not-for-profit for each question he gets wrong. Right, Marcus?
Oh, yeah. And that main one is my two sons. They're the biggest non-for-profit I got going. Good morning, all. Hope everybody is enjoying this beautiful sunny day. As far we say, calm before the storm.
That's right. It's going to be a lot of snow, Marcus. You're going to be digging out, and so will I, in about an hour, not an hour, about a day or so. So good thing we're having this webinar today.
Absolutely. Absolutely.
So what are we going to learn about today?
So our agenda is an overview of the Tax Cuts and Jobs Act. We're going to talk specifically how it affects individuals and non-for-profit organizations. The reason why we want to talk about individuals because it indirectly affects non-profit organization, one as potential donors, as well as sometimes some of your employees may be affected. So we want to highlight things that will be, directly and indirectly affect us. And then we'll have some time with some questions and answers, and hopefully I can answer Todd's multiple choice questions.
Well, I got one to start off with, Marcus, before we get started. So I think that this is an easy one. I gave you the easiest one out of all of them. Remember, $50, he said, to any charity. Well, we'll see about that. But so name the person who said the hardest thing in the world is to understand the income tax. You got 5 seconds. Beep, beep. Hardest thing in the world to understand is the income tax.
President.
No, it was not the president. It wasn't Donald Trump. It was actually Albert Einstein.
Albert Einstein.
Bianca's here with us. Bianca, can you write down $50 that Marcus now owes a charity for missing that one? I don't know if anyone out there got that, but it was Albert Einstein who said the hardest thing in the world is to understand the income tax.
Okay, so let's get started in our presentation. The one thing I want to talk about, this is an extremely exciting time in the world of taxation. This is the most sweeping tax reform since 1986. Now, I do realize some people were not born in '86, Bianca.
She wasn't born.
But that was just so overwhelming when it happened. But the difference between now and then was that Tax Act was signed in August. Effective 1/1 of the next year. This was signed on December 22nd into law. So the time that we've had to react has been extremely short. So experts, commentaries, everything under the sun has been giving their opinions on it. We have done research. We have said on webinars. We have given webinars. So what we're giving you here today in chart form, we know is pretty good, pretty standard. But some things that we're going to be interpreting.
Is that, you're actually giving like a caveat?
We're giving a caveat.
You're saying, don't rely upon what we're saying, is that what you're saying?
I'm saying that when you have reform or when laws are enacted, they're signed into law, and then the IRS's job is to write regulations to give guidance on how those laws should be applied. We do not have those regs. Those regs are not anticipated to be completed until 12 to 18 months later.
What?
So, again, the 86 Act, there was 6 months to react to it and get some guidance, get some temporary regs. Here we have nothing temporary. So there are things that we're going to take an assumption on, and we're going to tell you this is what we feel. But it may be changes to how it's actually applied. So once we get the guidance, that's when we'll become the experts. Also, some of these things are set to sunset in 2026. So all things are not permanent law. So those that we do know, we will definitely caveat that as well. Okay. So the first slide is how the GOP talked about simplified tax reform.
I love that. It's like postcards from the edge.
That's it. I mean, if anybody remembers when they were in their 20s, a 1040 EZ, that's kind of what that looks like. That's not the majority of taxpayers in this country. So I think it was a bit of a fantasy where they thought it was going to wind up, but that's what they thought originally.
So that's not what we got.
That's not what we got.
What did we get, Marcus?
So we got startup individual provisions. We went from rates starting at 10% all the way up to 39.6%. We wound up with, again, 7 brackets starting at 10%, but now up to 37%. So the highest brackets for married filing separate was basically 39.6%, and it was starting at income levels of $470,000. So not only did it go down a little over 2 points, but also the bracket lengths went down. So now, if you look at last year, if you had income of $500,000, your tax bracket went down 4 percentage points, which is a nice thing.
Well, that means people have more money to give away.
Yes, that's what we would hope.
That's true, though. Isn't that a true statement?
That's what we would hope, that they would give it away.
They're not paying as much in taxes, so they should have more disposable income to give to the charities, which is what I would advocate, as opposed to spending it on another Rolex watch.
Exactly. But there's some things that's going to happen that we'll see why that might be not so true.
Oh, no. Marcus is always a Debbie Downer. Go for it, Marcus.
Okay. Next, some things that kind of held, Pat, the cap gain qualified dividend rates stayed the same. There were no changes to that. And that also piggybacks into the net investment income tax. Now, this was a tax placed in service to help pay for the health care reform by the prior administration. It did not get repealed. It is still there. It's 3% of your net investment income. But you will probably pay more tax on this particular piece because there were deductions that were allowed against net investment income that are either limited, state and local taxes, real estate taxes, or totally repealed, the 2% itemized deduction. So in essence, this will increase the tax that you pay on net investment income. Okay. Our standard deduction was doubled, $12,000 single, $24,000 married filing joint. Okay, how that impacts us, we're going to talk about that in detail.
Slow down for a second, Marcus. So what you're saying there is that the prior standard deduction was what? What was the prior standard deduction?
$6,350 and $12,700.
Okay, so we're going to talk about that, but that's important to know because we're going to talk about why people in the past were asked to give money to a charity, and if you remember, the bottom always said, this is for a taxable deduction. Right, yep. Donation. Okay, absolutely. Go on.
Absolutely. Okay. Other things, personal exemptions were repealed. Okay, if levels were under $261,000 in a single, $313 married filing joint. You got for every exemption, for every individual in your household, your wife, your dependents, you got $4,050. That's gone.
They took it away.
Bye-bye.
Okay.
Okay. Child tax credits, okay, that was increased. It was $1,000, it's up to $2,000, And actually, it can be refundable now, up to $1,400. In the past, the child tax credit itself was not refundable. There was something called an additional tax credit that you can take, you can get $1,000 refunded back. But now, if you're in the 15% bracket, you can actually get $1,400 back if you don't pay any tax.
So this is actually encouraging people to have more kids?
Well, I think kids are very expensive, so I don't think that's an encouragement there, but it is something for the lower income brackets to have, again, more disposable income.
Okay, because they're actually going to get a refund. Is that correct?
Absolutely.
So for every child, you get a $1,400 refund unless you've used up that credit.
Exactly. Exactly.
So if you have 20 kids.
That's a limit now.
Marcus, you
I got Todd is encouraging people to reproduce.
No. Strike that from the recording. That's all I need is for that to go out on the internet. Anyway, no, I'm just curious because I think it encourages families, larger families, who obviously the more kids you have, the more money you have to spend on the kids.
Extremely expensive.
So I could see that was in the tax provision.
Yep.
Okay.
Yep.
Go ahead, Marcus.
Okay. Next, we want to talk about alternative tax, or AMT, a very sore spot in the Northeast, Northwest. Because we pay so much in state and local taxes, so much in real estate taxes, all of these things get added back to alternative minimum taxable income, and we had to pay tax on that. That is still in effect. It did not get repealed. What they did was they increased the exemptions, almost doubled them. So married filing joint went from $84,000 to $109,000. Single went from $54,000 to $70,000. So that would help move people out of that dreaded tax. But there are other items that we will talk about, mainly state and local taxes, real estate taxes, that for reasons why people were in AMT, now they probably will not be. So most people will be now at the standard rack rate as opposed to looking at alternative minimum tax.
Hold on a second, Marcus. What's a rack rate?
So we have.
They put you on the rack and force you
basically,
they actually pay your tax?
Not really. We basically look at.
You guys talking like a tax person, but go ahead.
I'm sorry, that's my nature.
I know, a rack rate.
Okay, an audit guy versus a tax guy,
anyway,
you know.
So tell them what a rack rate is.
So basically you have your rates of which we looked at, the standard 7 rate, but also in the instructions, if you've ever looked at any instructions, you have separate tax schedules that, depending on how your income goes from 0 all the way up to 99,000, that you could possibly be in. So as a shortcut, we kind of call those rack rates.
So who will, I mean, this is from a very practical perspective, or from a, who does this really affect?
Normally,
what dollar amount would you be making that you would actually now escape AMT, from what to what? Under
the old rules, anyone probably over 250, 275,000 up to probably 650, 700,000 could be an alternative minimum tax. Once you kind of got over 700,000, you were out of that particular realm, and you were really at ordinary income rates, probably around the 40%. So now with deductions of income that got eliminated from tax, really everybody should be more in the standard rates, more so. I think the people who were captured in that alternative minimum tax, again, Northeast, Northwest, probably are not looking at being an AMT anymore.
So again, just to remind everybody, and some people jumped on the call, the reason we're starting off by talking about the impact upon individuals, which we think is important for you to know for 2 reasons. One, because it does affect your donor base. Second, this also affects your employees and maybe yourself. So we think it's important to educate you on this. We're going to be talking shortly about how this specifically impacts the not-for-profit community as well. So Marcus, go on, and then after your next 1 or 2, I have another question to see if you're going to pay another $50 to charity. So go ahead.
Okay. So next piece is the limitation on itemized deductions, or the PEZ limitation. So if your income was over 261,000 single, 313 joint, you had a 3% itemized deduction limit, what you actually could deduct. That's gone, so that's a good thing. Here's a big piece that affects a lot of tax. So miscellaneous itemized deductions subject to 2% floor. That has been totally repealed. So deductions that people used to take as far as unreimbursed employee business expenses, investment expenses, or fees that you pay your brokers, tax prep fees, fees that you pay us to prepare your tax return.
Man, that hurts.
No longer deductible.
You're not going to be able to deduct.
Can't deduct my fee.
Preparer's fees.
Also, another big one, legal fees for preservation of income. Okay, so if you pay an attorney to do an estate plan for you, that's no longer deductible.
That's going to hurt them.
It's going to hurt.
They're not going to like that.
It's going to hurt. Now, these things also were deductible against net investment income. So again, that's what I stated earlier on a slide earlier, that it will increase the amount of net investment income tax that you pay on that at a 3.8% rate, because these items are no longer deductible.
Okay, Mark, it's time for another question. Who said this? You marked down that he already owes $50, right?
$50.
Okay. Who said the federal income tax is a disgrace to the human race?
Wow.
Who said the federal income tax system is a disgrace to the human race?
Wow. Bianca, hold up a scorecard or something. Wow.
No, that's a tough one, I know.
That's a tough one.
I'll give you one hint.
Go ahead.
Brother actually was, I think it was in some really, never mind. His brother was in some beer commercials, and he was a president.
Wow.
Oh, forget it. You
Just
take
write
the
$50 down.
Just write 50 down.
It was Jimmy Carter.
Mr. Carter, the
Right.
peanut man.
There you go. Remember his brother? Anyway, okay. Go on. So individual provisions, we're still working through these.
Still working through. Just a few more that we want to hit on. Medical expenses, the floor was reduced back to 7.5%, which was the floor for many years. It went up to 10%. State and local taxes, as real as taxes combined, are limited to $10,000 deductibility.
That's got to hurt, right?
This is huge. Again, Northeast, Northwest, we pay a tremendous amount of real estate taxes as well as property taxes. So we need to make sure that those items are taken into consideration, okay?
There you go.
I skipped the slide, sorry. I'm so excited about this stuff. I skipped the slide.
No,
but these are extremely important deductions that have been taken away. So if you or your staff or your donors look at this thing and pay attention to it, we're going to talk about how it really affects charities and how it's going to adversely affect them. We really just want to highlight that this is some of the background on what could possibly happen.
Okay.
Okay, mortgage interest, some limits on that. So it used to be you can deduct $1 million if you had a mortgage of $1 million and a home equity line of $100,000, so $1,100,000, you were able to deduct at 100% any mortgage interest you had. So that was basically on your primary residence and also on a vacation or second residence. Okay, that limit has gone down to $750,000 for mortgages acquired after December 15th of 17. And also the deductibility of home equity loans are in jeopardy, okay? So basically, when we first looked at this, we said, well, it looks like home equity loans are totally out, okay? But now there's some thoughts on the matter that if the equity loan or equity line has been taken out and 100% of it was used for improvements to your home, it could possibly still be deducted. So I've heard conversations, 3 different conversations on this. This is one of the points that we're going to need guidance from the IRS to see are there any exceptions to the elimination of the deductibility of the loan interest on equity, okay? There are loans that are grandfathered in, so if you had your line, okay, in, it may be a point of, again, deductibility as long as the mortgage was in before December 15, 17, the $1 million is the threshold, but we're going to need a lot of guidance on this thing here. Okay. Charitable contribution limitation. Okay, it is increased from 50% of AGI to 60% of AGI. Okay. On the onset, that sounds awesome. That individuals will be able to deduct up to 60% of their adjusted gross income.
It's the Santa Claus clause.
It is.
Isn't it? I mean, basically, you just keep on giving
Keep
gifts.
giving, keep giving.
Up to 60% of your income.
But we're going to talk about that.
Okay.
Is that reality?
Is that reality? Ooh. Well, don't tell me that Santa Claus isn't real. I'm going to stop buying presents for you if you do that.
Yeah, I don't know. Okay, so actually, let's talk about that right now. So, I understand that 50% or 60% adjusted gross income, what that really entails. So if I make $100,000 a year, what I'm saying is I can actually deduct $50,000 under old law or $60,000 under new law. But what's the reality of that?
I don't know.
I don't know too many people that give that much. It may be a whim on 1 year or so if you sell your business, have a windfall of income that you want it to give it a really unique impact on a charity or charities. So you have that type of disposable income. But on a normal case where the average taxpayer, very few give that much money. Even if you tithe to your temple or to your church, that's 10%. So $10,000 would be a lot. So is this really a help for charities? Out of the one-offs or the extraordinary donations, I don't really think so.
Well, I think your question is it an incentive for people to give more? That's what I think you're saying.
Yeah.
I guess if you do have the ability to give more, you might give that extra 10% above the 50, but you're right, it probably doesn't happen as much as we would like.
Yeah. Standard deduction, we mentioned a few slides ago. Okay, it was $6,350 for individuals, $12,000 for married filing joint. It's basically doubled to $12,700 and $24,000. So what happens here? Okay, the way I look at this is that taxpayers may pay less tax, but how is that going to affect nonprofits? Let's look at a couple of scenarios. Average taxpayer makes $150,000 a year, has a home, okay, pays real estate taxes, has a mortgage, okay, and pays state and local taxes. Just throwing numbers out. If they pay $10,000 in real estate taxes, if they pay $10,000 in mortgage interest, that's $20,000. They would pay state and local taxes, let's say, of $4,000. That would be $24,000. They would deduct now, dollar for dollar, their charitable contribution. $2,000, $3,000. We're up to $27,000, $28,000 of itemized deduction. The old standard deduction was $12,000 for a married joint. There's a lot of incentive to give to charity because I get an immediate write-off against my taxes. Now, let's roll that back. If I've got real estate taxes of $10,000, I've got state and local taxes of, let's say, $4,000, that's $14,000. That's capped at $10,000,
So you don't get that.
I don't get any excess over $10,000.
So they just max you out $10,000?
Totally maxed out.
No matter, even if you live in the state of New Jersey and you're being taxed in New York as well, you don't get that deduction on your
Absolutely.
Schedule A.
Absolutely. Gone.
Okay.
So both of those are tapped out at $10,000. And even if I had the mortgage interest of $10,000 now, that's only $20,000. My standard deduction is $24,000. So in order for me to get any benefit, I've got to give charities in excess of $4,000 to get any benefit of an itemized deduction on that charity.
So that will do what for?
So
what does that mean?
unless the particular exempt organization or charity is near and dear to your heart, meaning that you're going to give until you have no more money to give. It is important to you. It is significant in your life. It has an impact on you and your family. If that's not the case, many people will not give because they're not getting a tax deduction.
It's going to be interesting. This is Todd's personal commentary for a minute. It's going to be interesting to see how this plays out, and it's going to be interesting, and we'll talk about this later, how charities, not-for-profits, position themselves because, I mean, the question is, do most people give to a charity to get a tax deduction, or do they really give money because they believe in a cause? And, you know, I know for me, every time those people stand outside the ShopRite and they shake their can, I'm always pulling out my wallet and giving money because they're there in front of me, and I'm not looking to get a tax deduction for it. I'm doing it usually because I believe in their cause. Those are small dollar amounts.
Sure.
But That's good. Go ahead, Marcus.
So and there's been many studies on how this is going to affect charities. One of them was the Indiana University Lilly Family School of Philanthropy. They estimate it could be an adverse effect on charities somewhere between $4.9 billion and $13 billion.
With a B. Billion with a B.
Billion.
Well, at least it's not trillion. Isn't billion less than trillion?
Billion is less than trillion, but
Okay.
it's more than million.
Okay.
So this is huge. This is huge on our exempt organization. Okay, one other thing that they knocked out was the donee reporting exception. It used to be old rules that for cash, if the cash contributions were less than $250 for the year, or the what we would call quid pro quo, meaning that if you bought a ticket to a gala or a golf outing, you got a good or a service in return, the excess of what you paid over what you received back was a contribution. That was a $75 limit. Now, first dollar that charity receives from individuals, they have a requirement to make sure they have some kind of acknowledgement to the donor. Now, there's been a lot of issues back and forth with the IRS, basically saying, you know, what is good documentation? What is acknowledgement? They were considering looking at Schedule B to say if you're listed on Schedule B, you didn't have to show, give an acknowledgement. But that didn't make it because there are different thresholds of when Schedule B is required and who is actually required to be listed on Schedule B. So it could be greater than $5,000. It could be 2% of your total contributions for the year. So to eliminate that, they basically said they want contemporaneous acknowledgement. They want it substantiated. If the particular individual or taxpayer gets audited, they need to have an acknowledgement from the organization in their file.
This is the threshold $1?
$1.
So good thing. If you get 23 cents, you don't have to acknowledge it, is what you're saying. Well, I've been talking to some of the not-for-profits about this, and many of them do send acknowledgement letters regardless of the threshold. But just in case out there, if you've been using the $250 threshold and not sending acknowledgement letters to anybody below that number, now you need to do that, provided it's over $1. But below $1, the IRS is cutting you a break.
Small break. Small break.
$1 break. Under $1 break.
Okay, here we're getting into some high-level stuff. Excise tax on executive compensation. Okay, so there is a 21% excise tax that the organization has to pay over compensation over $1 million. That's pretty big. Okay, so basically, we talk about covered employees. Covered employees are normally your C-suite employees or your 5 highest compensated employees. That compensation is including wages, it's including benefits, and basically you look at the who's considered a covered employee for the prior year. So the 17 tax year, if they are employed by the organization, now in 2018, if they still receive compensation, that's the cover period. Then even though they may not be employed or retired, so to say, if they're receiving compensation over the $1 million in 18, the organization is subject to the tax.
21%.
21%.
Well, I mean, how many, though, just to be, again, my own personal commentary on this, how many executive directors or CEOs or CFOs make over $1 million? I mean, isn't that, I mean, I would wish for all my not-for-profit C-suite people on the line to make over $1 million.
Absolutely.
And
they deserve it.
And that their not-for-profit still thrives on top of that. But I mean, many not-for-profits are not that big. So what was this really intended for?
I think there's 2 particular exempt organizations they're looking at: big universities, colleges, and also hospitals.
The sick and the educators?
Yeah, there are a lot of issues with exempt hospitals, and if there are any C-suite individuals from hospitals, I apologize, but there's been over the last 3-4 years things about real estate tax exemptions for hospitals the charity care, the 501R regulations. So I really think that they're trying to buckle down on tax-exempt hospitals as well as tax-exempt colleges and universities on how much actual compensation that their particular C-suite executives are getting. Now, one of the things that I do want to comment on, this was also made to kind of par with large publicly traded companies. So this also impacts those folks as well. So if you're paying, you're a public company, IBM or whatever, and you're paying your C-suite executives over $1 million, this tax is going to apply to you as well.
So it's not just a not-for-profit?
Not just the nonprofit. So they had to push it onto the nonprofits to make them more comparable.
Are they going to take the 21% excise tax and give it to the not-for-profits who really need it?
I don't think so.
That would be fair.
That would be fair.
That would be fair. It's not. I mean, again, there's a lot of debate. I don't know if those who are listening know, and I've been in the middle of it, but I don't take sides between whether or not-for-profit execs should be paid as well as those in public companies or privately owned companies, or should they be paid less? And I know there's certain people out in the not-for-profit community who voice one way or another,
sure.
But here pretty much it's clear that the Internal Revenue Service or Congress is saying if you pay somebody over $1 million, you're going to be, the not-for-profit is going to suffer a consequence.
Mm-hmm.
21% excise tax is pretty hefty.
Big number.
That's a big number. That's like a fifth.
It's every dollar over $1 million.
Yeah, that's a lot. But okay,
a lot.
Go ahead.
Now, one other thing I want to comment on, in the case of medical professions, there was a carve-out. So if your C-suite executive is an actual doctor or nurse, and they actually still performing services in that capacity, as well as services as an executive director of the hospital or president of the hospital, those services should be carved out separately because they are not subject to this tax. So we want to just make sure that is known. Those services will not be penalized. Also, one thing that will affect our smaller nonprofits is something used to be called separation payments or golden parachute payments. Okay, that was basically something that was a buyout or severance package that employers used to give employees or key employees as kind of a lump sum as you retire to go away with. So if those types of deferred comp packages are being looked at or currently in place by our exempt orgs, we need to look at that because the base for that is very low. Okay, it's basically, you look at that as your last 3 or 5 years of service, and it averages your comp. If that averages 120,000 or more, you're subject to this particular tax as well.
So you could not be making $1 million a year and still get hit with this?
Still get hit with that 21%.
That's not good.
No.
Man, now it's definitely not fair. So Marcus, it's time for another question of who said this. You're up to $100 that you owe some not-for-profit. We're not going to pick it for you, but we're also not going to police it, right, Bianca? But you'll stop by his office. You'll stop by his office every day and see if he did it. So see if we can get you up to $150. Who said the income tax has made more liars out of the American people than golf has? Even when you make a form, someone like that. So even when you make a tax form out on the level, you don't know when it's through if you are a crook or a martyr.
Wow.
Who said that one?
Who said that? I'm going to go on a line and say Oprah Winfrey.
Oh, no, it was Will Rogers.
Will Rogers.
Well, we're actually digging back into the past. You can see that taxes have been a problem all along the American history. Once they started, they haven't stopped. So go ahead, keep going.
Okay.
Yeah, you're on a roll.
We're on a roll. Okay, another thing that affects colleges and universities, private colleges and universities, there's a 1.4% excise tax on net investment income, okay? And basically, the rules are if the private college or university has at least 500 students, looking at the preceding tax year, and they have assets of greater than $500,000 allocated per student, okay? And if you have related organizations, so it could, the college or university could have a foundation that is related to it and have assets there, those assets get pulled into the computation, okay? I have a theory on this, Todd, on why the IRS is doing this. So this is my theory. It's not in stone, but I believe some of our colleges or universities have such large endowment funds that they are just growing and growing and growing. They're in the billions, not millions, billions. That the IRS is looking to have them start to really give that money out to charity, to scholarships on what they were really purposed for, or for infrastructure that the universities are in dire need of. So I think this is kind of a play on them to move colleges to start moving, getting rid of some of those endowment funds and really putting to use on what they were purposed for. Thoughts?
None.
Okay, unrelated business income. Very scary topic for some particular organizations. So we know we are allowed to take in revenue that is under what's called our exempt purpose. So it could be client fees, it could be rental income if we're housing organizations, but if we're selling mattresses, that clearly is income that's not related to our mission, although the money may be going for the mission, it's not related to. So items like that are subject to unrelated business income tax. Okay. Some of the things that used to be deducted on an allocable portion are not deductible anymore. So these fringe benefits that we used to give our employees, the taxable fringe for transportation, parking facility usage, and also if we have an athletic facility, which is basically defined as a gym or a health club that we used to give free membership for our employees or a reduced rate. Those things are no longer deductible and they have to be added back to unrelated business income. Okay. Some other items on unrelated business income. The new law talks about separate activities. So an example of that, you may have advertising income that's subject to unrelated business income. That could be a plus. You can also have rental income. If you have debt on the buildings that you're renting, you have to compute what the actual taxable income is on that unrelated business income if the rental piece is greater than 15% of the total usage. Two different activities used to be able to net against one another on the 990T. Now you have to keep them separate. So it's a little more than passive activity rules under 469. It's almost like publicly traded partnership rules, whereas every activity stands alone. So if I have rental income on advertising, I cannot offset the loss that I have on the rental. So I have to basically capture that loss and hold it until I have income in future years and pay tax on the advertising income. So you have to almost every activity in a bucket approach, okay? So that's huge, and that's going to basically make exempt organizations pay tax. Also, limits on net operating losses. So if we have net operating losses carried forward from prior years, okay, we believe we're going to need more guidance on this, but we believe it's going to be limited to 80% of taxable income. So again, tax reform, reduced tax rates, reduced number of individuals paying tax. You got to basically fill in that gap. There's got to be revenue raisers. So this is one of the revenue raisers. But this is not fully understood, or that we need regs, we need guidance on how this is going to affect exempt orgs. We believe it's going to be an 80% limit, but we'll see that once the regs are written. But also the one good thing is that the exempt orgs are subject to the C Corp rate. So that rate was reduced from 34% down to 21%. So even though we're going to have a larger tax base, we're going to pay less tax as a result of the reduced rate. One or two other small things, length of service awards for public safety volunteers. So this basically was something we gave that was allowed for volunteer public service persons. So namely volunteer firemen, volunteer police, those kind of folks who don't really get compensation. They had no type of retirement. So basically, there was laws enacted that to allow them to the towns or municipalities to put money away for their benefit, and it was kind of a deferred comp plan. So it could have been either a defined contribution or a defined benefit plan, and they would be able to have some kind of retirement savings. So that was an incentive to become a volunteer fireman or volunteer policeman. Those were limits to $3,000. And now they basically doubled those limits to $6,000, and it automatically adjusts for inflation in increments of $500. So that's just a really nice feature, and they put in for our volunteer service people.
The next one is a big one, right, Marcus?
Next one is very big. Estate exemption. Okay, so that has basically doubled from 5.5 million to 11.2 million, and it will be adjusted for inflation per individual. What does that mean? Okay, so that basically means that you can transfer wealth from yourself upon death to your heirs to the tune of $11.2 million. So that originally, way back when, was $1 million. Then it went up to 2 million. And then the 5 million. We thought we had hit the pay dirt when we got to $5 million. Now it's double. Okay, that's huge in the well.
$1 million.
Can you mute, please, whoever is on that line? Thank you. So we've done a lot of estate planning over the years to kind of shoehorn people into the 5 mil over the last 3-4 years. Now it's doubling. You still need some estate plans, but the fact of the matter is I've got a $10 million estate. I don't have to do anything but leave it to my estate, and it goes out to my heirs tax-free. Now, that's federal numbers. States have different numbers. New Jersey have different levels, but let's just stay on the federal side of it. One of the ways that people used to, in our estate plans, was to leave money to charity, okay, upon death. So if I can transfer now $11 million to my heirs tax-free, do I have a lot of incentive to go to charity? Again, if it's near and dear to me, if I've supported it all my life, I'm going to leave money to that charity. But if not, as just an estate plan mechanism, what's the incentive? That could really hurt our exempt orgs.
Dramatic pause. Okay, go on.
That pause was on purpose.
Yeah.
Just a few other items here that's going to affect those organizations. Moving expense reimbursement as well as deduction is gone. So some of our organizations, you need a C-suite employee, you need executive director, you need a CFO. You pay them a relocation piece, and you're able to get a deduction for it. And as long as they used it for moving, it was not taxable to them. Or on the reverse, if you just gave them an increase in income, they took it as salary, and then they were able to deduct their moving expenses on the 1040. Well, both of those are gone. So any relocation expense or any additional monies input into the employee's compensation is 100% taxable in order for anything to be deducted on the organization level. So that is for-profit as well as non-profit. I don't know why they carved this out. Somebody must don't like bicyclists, but they took the bicycling commuting benefits
Probably
out.
wants to get a bicyclist.
So, you can have a $100 bike or you can have a $2,000 bike. If you use it for work, no break. And also employee achievement awards. You know how you have the 2-year, 3-year, 5-year, 10-year awards. You give them a check and a certificate saying, congratulations, you've been with our company for 5 years now. Those used to be what's considered de minimis. Now every dollar is considered compensation.
What about, Marcus, meals and entertainment?
Meals and entertainment. Now, for exempt orgs, it really doesn't matter because we're not paying tax. But on the for-profit world, if you took a client out for lunch or for breakfast or for dinner, you're talking business, it was deductible at 50%.
I was told this morning by Larry Gratzky that actually stayed in the bill. The 50% part did, but the entertainment part did not. How does that impact not-for-profits? Does that impact us actually attending their golf outings, and does that matter, or is it deductible?
I think it's going to matter. It's going to matter because it's still considered entertainment.
So it's entertainment because but that doesn't make a whole lot of sense. But okay, I guess we need to circle back on that.
This is one of the things that we're going to need some guidance on. But when the initial bill came out, it said all meal and entertainment used to be 50% deductible. Now it's 100% taxable, which affects, what we would call business.
Right. And Larry said that the meal side is the 50% stage, but the entertainment side apparently restaurants.
Here's the guidance on what that is. What's going to be considered entertainment is a gala entertainment, golf outing entertainment.
So if you can't take it as a charitable deduction because obviously there's some type of benefit that you receive. In the past, you could take that as a deduction.
That's what a lot of business entities would do. It's a cost of doing business. So they would look at it under 163 as a cost of doing business, ordinary necessary, and they would take it under those particular sections. But again, this is stuff that really we're going to have to look at and look for the guidance on how it's going to be treated. I know one thing that they attacked, years ago they talked about the country clubs. So, many attorneys and high-level executives say, I do business at my country club. I want to write off the country club dues. And they specifically put in that's got to be out the door. So what they did is they attacked colleges now. So if you have season tickets to college events, that is non-deductible, 100%.
Let's talk about some steps that not-for-profits should take in light of this. Marcus, you have them up there. Go through
it. So you should assemble your team, your marketing teams, your development people. Talk about how this is going to impact your particular organization. Okay? Dig into the data. Understand what it means to you. Tax reform. That means consulting your tax advisor. That means like calling up guys like myself, like Todd, like Josh, like Al, to talk about how this really is going to affect us. Okay? And then let's start devising plans. Look at fundraising, especially in Q1 as that is winding down into Q2 of 2018. I don't think the normal taxpayer is really going to understand how this is affecting them until way later, of Q4 in 18 or first quarter of 19. So you want to get in front of those donors. To make them understand that you really need them. The organization needs them. Call in wealth management firms like ours. We have a very strong wealth management arm to discuss things like planned giving or donor advised funds. Donor advised funds are huge and hot right now. Also things like required minimum distributions from our taxpayers that are over 70 and a half years old that have to take required minimum distributions. That was made permanent that you can take $100,000 of your required minimum distribution for the year, donate it directly to charity, and now you pay no income tax on the withdrawal, and you don't get a deduction, but it doesn't figure into your taxable income. And also look at stock donations. That still is a great way to get money to an organization. Appreciated stock with low basis. It's donated at fair market value.
So Marcus, before I give you my last question, let's see if we have anybody or if anyone has given us some questions to answer. And again, if you guys could just, some of you haven't muted your phones. If you can mute them, that would be appreciated since we are taping this. And we love to hear your voice, but not on this tape. So if you could go and tell me, do we have any questions here?
ATM, what is the income level for married filing jointly that would put you into the ATM? Okay,
that's alternative minimum tax. Normally, like I said, it used to be if you were a married filing joint at anywhere from $250,000 to $300,000, Again, Northeast, Northwest, you probably were in alternative minimum tax. Now, because the exemption is higher at $109,000, also those deductions for state and local taxes, real estate taxes, are capped at $10,000. Those deductions could have been upwards of $25,000, $30,000. Those would get added back to alternative minimum tax. I think who we see or persons that we see in alternative minimum tax won't be as significant anymore. So the income levels, you won't know those until the 2018 forms come out to see exactly how it is. And again, it depends on a case-by-case situation, because there are things that can put you in alternative minimum tax other than state and local taxes and 2% itemized deductions. You can have differences in depreciation, or if you sell a property, that's a huge gain difference that had difference in depreciation for regular and AMT purposes, that could swing you in. There's also non-qualified stock options. If you had that could swing you in because it's exempt from regular tax, but it was added back for alternative minimum tax.
So you're asking about whether or not the slides would be made available. This presentation is going to be recorded and actually will be posted on our website, so you can listen to it again, and the slides will also be available on the website, right? Okay, I'm getting a nod yes, so that's good. So up there was, yes, still some, can you send us a link to where on the website, please? Yeah, we'll send out to everybody who called in a link to the website where you can actually listen to this again or get the slides and send it to your friends. So one last question, Marcus. This is for you now to owe $200. Just one last question.
Nice round number. Good.
Yes. Who said the only difference between a taxman and a taxidermist is that the taxidermist leaves the skin?
Wow.
The only difference between a taxman and a taxidermist is that the taxidermist leaves the skin.
I want everybody to know, Todd knows I'm extremely charitable, so the $200 that I'm going to cough up will be for a good charity.
Yeah. If you want to request it to go to you, his email address is on the presentation.
Absolutely. If your particular organization is worthy, I will donate $50 to it.
Okay, there you go. So Marcus, there's 100 people on the line. That's 50 times 100 can be more than the $200 you're going to owe. But take a guess. Who do you think said that?
I'm going to guess an entertainment personality.
Close. Go ahead.
I would think Jim Belushi.
That would be good, but no, it was Mark Twain. So, well, thank you, folks, for participating. You will get the link to this. You'll be able to listen to it again. And feel free to share it with all your friends. And until next time, have a great day. And we are out.